Hello candidates. So today we will review forward commitments, the valuation and pricing of forward commitment contracts. So we will be moving learning outcome statement wise. So the first learning outcome statement is describe how equity forward and futures are priced and calculate and interpret their no arbitrage value. See, first of all, what is pricing? Pricing involves determining the appropriate forward commitment price or rate when initiating the forward commitment contract. See, suppose you are entering into a contract with your friend and you say that I will be buying this one lot of one lot of woods from your friend 1 year from now at rupees 10. So this rupees 10 is your forward price. And valuation. Valuation involves determining the appropriate value of the forward commitment after it has been initiated. Suppose after few days, after like 1 or 2 months, you agreed to at initiation of the contract, you agreed to buy one lot of woods at rupees 10 1 year from now. And after 1 month, the current price of the wood has increased to rupees 12. So now you know that the current price of wood is rupees 12 and you are having a contract to buy wood at rupees 10 1 year from now. So definitely you are having some particular advantage, because even if the wood's price 1 year from now goes up to 15 or 16 or like rupees 20, even then you will be able to buy the wood at rupees 10. So valuation means how to determine the value of the contract, so that if you want to sell this contract to someone, how much benefit can you expect to get out of it. So the pricing is like, let's say this is the timeline of the contract, 0 T and capital T. The capital T is the point where the contract will expire. Okay, this is the expiration of the contract. So in our example, the expiration is at 1 year, because you have entered into the contract to buy wood 1 year from now. Okay, so this small t is any time between the initiation and the expiration, at which time you can calculate the value of that contract to get an idea that how much benefit you can expect from selling the contract. Let's see few examples out here. The continuously compounded dividend yield on Euro stocks 50 is 3% and the current stock index level is 4500. The continuously compounded annual interest rate is 0.3%. Based on the carry arbitrage model, the 3-month futures price will be. So how to determine the future price? See, suppose at point 0, like in this example, at point 0 you have the value of 4500. Okay, so for your contract to be arbitrage free, the price at which you will be willing to buy the contract, right, it should be like the future value of current value. The current value is 4500. So the value here should the forward price that you are agreeing to buy the contract for must be the future value of 4500. So how you can calculate the future value of 4500? That is, since it is using a continuously compounded rate, so the future price will be 4500 times e raised to power, what is your annual interest rate? It is 0.3%, so 0.003, and the dividend yield on the stock is 3%. Now see, the dividend yield is kind of a carry benefit, the benefit that you can expect, the benefit that you will have if you hold the stock today. Instead of buying the stock 1 year from now, if you buy the stock today and hold it for 1 year, you will get a 3% return. Okay, so the forward price should take that into consideration. If you are not buying the stock and you are buying the stock 1 year from now, you will lose money out that, right? The 3% benefit that you are getting from buying the contract today, you will not get that benefit if you buy the futures or forward contract. So the forward contract value will be will become lower because of this benefit. So it will be 0.003 minus 0.03 times 1 times, this is like you are calculating the 3-month future price. So the time here is going to be 3 divided by 12. So your answer will be 4469.73. So this is the forward price that you will be willing to buy the contract for, the 3-month futures price. So let's come to the example 2. Suppose we bought a 1-year forward contract at 101 and there are now 3 months to expiration. The underlying is currently trading at 110 and the interest rates are 5% on an annual compounding basis. If there are no other carry cash flows, the forward value of the existing contract. See, here you will have to calculate the value of the contract. First of all, you initiated the contract at this point, the current point is this, and this is your expiration. Okay, you bought a 1-year forward contract at 101. The contract value here was 101. Let's say the forward price that you determined at initiation is 101. There are now 3 months to expiration. 3 months. This is your T point, this is your capital T, the expiration, this is your initiation point. So you have got 3 months to expiration and the current underlying value is 110. So what you need to do is, first of all, you need to calculate the forward price as of T. How you are going to calculate that is 110 times 1 plus 5%. Since this is an annual compounding, you will, and there are 3 months to expiration, the 110 value 3 months from now based on annual compounding will be, so this value is going to be 111.35. Now since this is the futures price that you can get into, this is the futures. See, this is the futures price that anyone, if anyone enters into the futures contract today, he will be getting a futures price of this. But you entered the contract at a futures price of this. So after 3 months, you will be able to buy the underlying at 101 because you hold this this futures contract. But anyone, like any other person who is entering into the contract at T, he will have to buy the underlying at this price. Okay, so you are getting a benefit at T. The benefit to you at expiration of the contract is FT minus F naught, the futures price that someone else is paying minus the futures price that you are paying. So your answer here is 10.35. But see, this is the benefit at expiration. You need to calculate the benefit today from this contract so that to calculate the value as of today. So the value of the contract at T is equal to the present value of Ft minus F naught. So the present value comes at present value of 10.35. It will be 10.35 divided by 1 plus 5% raised to power 3 by 12. So your answer is 10.22. So this is the value of the contract at point small t. Describe the carry arbitrage model without underlying cash flows and with underlying cash flows. Now let's see what is the carry arbitrage model. See, the carry arbitrage model and reverse carry arbitrage model, they both work like, even if you buy the underlying today or you buy the forwards or futures price, you must be indifferent between these two at the initiation of the contract. Okay, now let's discuss the carry arbitrage model. See, when you enter into a forward contract, there should not be any kind of arbitrage opportunity available to you. Okay, if there is an arbitrage opportunity, you can take advantage of it. There are two scenarios. First one is carry arbitrage model and the second one is reverse carry arbitrage model. In carry arbitrage model, you are carrying the underlying and selling short the forwards or futures contract. Okay, in reverse carry arbitrage, you are carrying the forward or futures contract and selling short the underlying. So how do you determine whether you want to go for the carry arbitrage model or you want to go for the reverse carry arbitrage model? So it depends upon the current spot price and the forward price. So see, if the current forward price is greater than the future value of the spot price, that means the forward contract is expensive as of today. So in that case, what you will do is you will sell short the forward contract and buy the underlying. That is carry arbitrage model. Because see, when the contract will expire, you will have to sell the underlying, okay, to offset your forward contract. So your that underlying you purchased today will help you offset that exposure. So, and the second scenario is if your forward price is less than the future value of the spot price. In that case, your underlying is expensive. So what you will do is you will buy the forward contract and sell short the underlying. So at expiration, when the prices will converge, what you can do is you can buy the underlying at lower rate because your forward price was lower. So you will be able to buy the underlying at that forward price that you agreed to at the initiation. So for no arbitrage opportunity available in the market, the forward price should be equal to the future value of the spot price. Now this was the case when there were no cash flows associated with the underlying. But what if there are some cash flows along with the underlying, whether you are getting some benefits or you are you have to record some cost. So let's see what are the carry costs. Carry costs are the costs that you will incur if you hold the underlying with you. So let's say if you are holding a particular like physical commodity, you will have to consider the factors such as waste, the storage cost or the insurance cost. These costs are generally zero for financial assets, but if the financial assets that you are buying them with the leverage, then the interest cost could be considered as a carry cost. Carry benefits are the benefits that you get from holding holding that particular asset. Suppose if you are holding any kind of real estate, you will be getting the rent out from that real estate asset, or if you are holding any financial assets like equities or something, you will be getting the dividends on that. So those are the carry benefits. Carry benefits always see, the carry cost will increase your forward price because you are getting some kind of benefit from not holding the asset, right? You are avoiding these costs, so your forward price will be increased by the carry cost just to avoid the arbitrage opportunity. Now let's talk about the carry benefits. See, carry benefits but you are, by holding the forward contract, you are letting go of these carry benefits that you might have received if you were holding the particular underlying. But since you are not holding the underlying, you are letting go of these benefits, so that it will lower your forward price, the price that you will be like willing to pay to buy the underlying 1 year from now. Suppose a particular stock is paying like 5% dividend in this 1 year, and but you are entering into a forward contract to buy the equity like 1 year from now, so that means you will not be receiving that 5% dividend. Okay, so in that case you will surely pay less after 1 year than you will be willing to pay today, because you are letting go of that 5% dividend by holding the forward contract. So if we consider the cash flows, the carry benefits and the carry costs, the forward value of your contract will be equal to the forward value of spot price plus the forward value of the carry cost, minus the forward value of your carry benefits. So this is the forward price with cash flows associated. And if we are talking about the continuous compounding, in that case your forward price will be equal to your spot price exponential this is your interest cost for the year plus the carry cost minus the carry benefits times T. Now see, if the carry costs are greater than carry benefits, your forward price will be higher than your spot price. Okay, and if your carry benefits are greater than your carry cost, your forward price will be lower than your spot price. At expiration, these prices do converge with each other. Now let's see, describe how interest rate forwards and futures are priced and calculate and interpret their no arbitrage value. First of all, what do we mean by pricing of interest rate forwards? The pricing means determining the fixed rate so that the value of the forward FRA contract at inception is 0. Now let's first understand what is an FRA contract. Suppose you want to raise some money at point H, okay, for the duration of m months, and like you are worried that the interest rates might go upwards, and you want to fix that interest rate that you will be paying at period H. So what you can do is you can enter into a forward rate agreement today. So your rate will be fixed for your interest, which will be beginning at point H for the duration of m months. So how to determine that fixed rate? That fixed rate should be so that at initiation at point 0, the interest payer and the interest receiver, they should be indifferent. Okay, no single party should be like getting any benefit out of this contract. So the value of the FRA contract at inception must be equal to 0. So let's see how to price an FRA contract. Okay, so to find that fixed income, to find that fixed interest rate that you will be paying for the period from H to T. See, if you are raising money if you are raising money today for T periods, you will be paying an interest rate of 1 plus L, let's say here is the interest rate LT times TT. Okay, it must be equal to the interest that you will be paying if you raise the money first of all up to H periods, then you renew that loan for M periods. Once you solve this equation, you will be getting LM is equal to 1 plus LT divided by 1 plus LH minus 1 divided by TN. So this is your fixed rate that you are fixing today for a period of M, like for M months period from H to T, and the interest receiver and the interest payer, they both are indifferent between this. So the party who is first of all, let's see what is meant by a 3/9 FRA. A 3/9 FRA means the FRA expires at H equals to 3 and your capital T is T equals to 9. That means you will be paying the interest for 6 periods starting after 3 months. So 3 by 9 means the FRA contract expires at month 3, interest paid for 6 months. Okay, so who is the long FRA? Like who buys FRA? You buy an FRA contract if you want to pay a fixed amount and receive floating amounts. And short FRA means if you want to receive fixed amounts and pay floating amounts. So just as we priced an FRA contract, similarly we can also value the FRA contract. For valuation, let's see what happens. Like you entered into an FRA contract at initiation, okay, at time equals to 0, and the fixed rate that you determined at that point was FRA 0. So you were willing to enter into a contract with a fixed rate of FRA 0, that the loan will be beginning at period H, okay. But at point G, you decided to value that contract, and once you the fixed rate that you calculated at point G is FRA G. So if someone comes in and enters into an FRA contract at point G, they will be paying FRA G, the fixed rate of FRA G, okay. But you are paying an FRA rate of 0 at time equals to 0, that we set at time equals to 0, FRA 0, okay. So the difference between these two rates will determine whether you are benefiting from that FRA contract or not. Like say interest rates have increased, okay. So the person who came after you is willing to enter into an FRA contract at a higher rate. So in that case, your FRA G is higher than your FRA 0. So that means that person will be paying more than you to So that means that person who came after you will be paying more than you to oblige his obligations, okay. So that means you are at a benefit after entering the FRA contract. So the value of the FRA contract for you will be positive, okay. So how to calculate that value? You can calculate the value as the difference between the interest rates that you will be paying and the interest rate that you determine at point G. The difference between these two rates times the time for which the interest will be paid, like this time, into the notional amount divided by, and you need to see this difference is like this will be paid for a period of T at expiration, okay. The interest will be paid at this point. Once you entered into the loan, you will be paying the interest at this point. So you know that the difference between the interest payments is like notional amount times the difference in the interest rates times the duration of the loan, okay. Now you need to discount this difference back to point G to calculate the value at G. So how to discount that? You can use this equation to discount that. 1 plus the discount rate for period T to G times the time of T to G, okay. So that's how you calculate the value of a long FRA. Let's see, describe how fixed income forwards and futures are priced and calculate and interpret their no arbitrage value. See, the forward price is always like the same, the spot price plus any carry benefits plus any carry cost minus any carry benefits. So in case of fixed income means the bonds or anything, okay. So in case of fixed income, your spot price will be your quoted price plus any accrued interest. The interest that that bond has accrued at, like, when you are willing to buy that contract, or until now, like from its last coupon payment. Okay. So the forward price in this case will be equal to the forward value of the current spot price, full spot price B naught plus AI naught, minus the forward value of any coupon interest. The coupon interest is like the interest that you will be missing by holding the forward contract. So that will come at, that will be your forward price. And there is like once you enter into a forward contract, now there are like multiple you can say multiple underlying assets that someone can deliver to you, matching the same durations and all that. So to take that into consideration, we use a conversion factor. This is your forward price, and the quoted price, the price that will be quoted in the market, will be your forward price divided by your conversion factor. Okay. So now how to calculate the value of any long futures or forward contract? The concept is same, like you entered the contract at a forward price of 0. So you are willing to buy the underlying. Let's see, this is your initiation 0, this is your current time, and this is your expiration of the contract. Okay. So you are willing to buy the underlying at a price of F naught at time t. Okay. But at point G, someone else comes and they are willing to buy the forward. They enter into a forward contract, and they are willing to buy it at price G. Okay. So the value that you are getting from holding the contract is the difference between these two prices and their present value. So the value of the contract at T is equal to the present value of the difference between the forward prices that you calculated. So the next learning outcome statement is, describe how interest rate swaps are priced and calculate and interpret their no arbitrage value. See, a swap contract is an agreement to exchange a series of cash flows at certain periodic dates. Okay. Swap is different from FRA because swap hedges multi-period interest rate risk, whereas FRA hedges only single period risk. As we saw that when you are dealing with an FRA contract, you are only considering a loan of a particular term, like of 6 months or 3 months. But in case of swap contract, what happens is you are exchanging a series of cash flows. So it handles a multi-period interest rate risk. Okay. So how to calculate the price of the swap contract? The price is, once you enter into a fixed for, let's say you enter into a fixed for floating swap. So the one leg is the fixed interest rate, the other leg of the swap contract is the floating interest rate. So you enter into a contract where you are paying fixed interest and receiving a floating interest. Okay. So at the initiation of the contract, the value of the swap contract must be 0. That means someone should be indifferent between receiving the fixed leg or receiving the floating leg. So how to calculate that? You need to calculate the fixed rate using this formula. So what this formula is, suppose you have got like these discount factors, 3 months, 6 months, 9 months and 12 months, and you are getting different interest rates. So for these particular interest rates, you will be calculating the present value factors of these interest rates. Okay. So using these present value factors, you can calculate the fixed rate that someone will be willing to pay to enter into the contract. Okay. So how to value these swap contracts? If you have entered into a pay fixed swap, okay, you are paying a fixed rate. What you will do is, you will calculate the fixed rate as of today at point T, and then see the difference between these two rates. Okay. If the rate that someone is willing to pay today is more than the rate that you entered into a contract on, Okay, so that means you are getting a benefit because someone else is willing to pay more to enter into the same contract. Okay, so that means you are getting a benefit. So how to calculate the value? First of all, the value will be the difference of these two rates times the notional amount, and since it's a series of exchange of cash flows, you are exchanging a series of cash flows. Okay, so you will be adding the present value factors together, because at each point of time, like at each you can say at each interval end, you will be exchanging cash flows. So you need to consider the whole series of cash flows together. Okay, so that's how you value the pay fixed swap. And if you are receiving a fixed amount, then it means that you are receiving a fixed amount, and if someone else is receiving a greater amount today, that means you are having a loss. Okay, but if someone else is getting lower payments today to enter into the same contract, then you are at a benefit. So this is the formula to calculate the value of a receive fixed swap. Now let's say how to price the currency swaps. What happens in a currency swap is, at initiation you exchange the notional amounts. Okay, at the initiation you exchange the notional amounts, then you exchange the interest payments with some other party, and like suppose you are paying the interest in currency A and receiving the interest in currency B. Okay, so the other party is like paying the interest in currency B and receiving the interest in currency A. At the expiration of the contract, the notional amounts will be exchanged again just to offset the exposure. Okay, so there are two fixed rates that you need to calculate with the currency swap. For each currency you will be calculating a different fixed rate. So let's say for currency A you can calculate the fixed rate like this, then for currency B you will be calculating the fixed rate like this. The notional amount will depend upon the spot exchange rates of the currencies. Okay, so let's say how to value those contracts. The value of currency swap at time t for someone who is receiving the payments in currency A and paying the payments in currency B. Since you are receiving the payments in currency A, the value of the swap for you will be the value of a fixed bond in currency A minus the current spot rate times the value of bond in currency B. Okay, think of suppose you are getting a series of payments in currency A. So how can I calculate the value of those payments? Those payments are like I am receiving the interest payments, and at expiration I'll also be receiving the notional amount of in currency A. So that means it is equivalent to having a long exposure in a fixed rate bond in currency A. So I am having a long exposure. Okay, so what I will do is I will calculate the value of bond in currency A and subtract the value of bond in currency B to calculate the overall value of swap. Why am I subtracting the value of bond in currency B? Because I have a short exposure in currency B. I am paying the interest payments in currency B, and I'll also pay the notional amount at expiration in currency B. Okay, so I'm having a short exposure with currency B. So to calculate the overall value of the swap contract, I will subtract the value of bond in currency B from the value of bond in currency A. Now the main thing here is how to calculate the value of a fixed bond in currency A, let's say. So you know that you are receiving a series of payments first of all. So R fix is the rate of interest that you are getting times the present value factors. The summation of present value factors I have taken here because you are getting a series of payments. So let's say you receive 4 interest payments at the fixed rate. So you will be either you calculate the present value of all those 4 payments like individually, or what you can do is you can just add the present value factors together and multiply that with a fixed rate to calculate the overall present value. So that's what is done here. I have added the present value factors together and then I have multiplied that with the fixed rate. Then I'll be adding the last present value factor, because at expiration I'll also be receiving the notional amount. Okay, so that present value factor is also added. Okay, it is multiplied by the notional amount in currency A. So this gives me this whole expression. It gives me the value of a fixed rate bond in currency A. Okay, so I'll subtract the value. Similarly, I can calculate the value of fixed rate in currency B. I will subtract that value from the value of bond in currency A to get my overall value of currency swap. So that's how the values are calculated for currency swap. So the last topic in this reading is describe how equity swaps are priced and calculate and interpret their no arbitrage value. See, there could be like three types of equity arrangements, equity swaps. First of all, you are like paying equity return and receiving a fixed return, or you are paying equity return and receiving a floating payment like for floating interest rate, or the case could be like you are paying one equity for another equity. Okay, so out of these three type of contracts, we are only concerned with the equity with fixed payments. Okay, so I'll be calculating the fixed payment similarly as I did with currency swaps and interest rate swaps. Okay, I'll calculate the fixed payment to be paid, to be received or paid. Okay, so now the thing is like how to calculate the value of receive fixed pay equity swap. Since you are receiving fixed payments, that means you will be calculating the value of a fixed rate bond where the fixed interest rate is equal to the C naught, the rate that you calculated here. Okay, so this is the fixed rate value of fixed rate bond that you are receiving. Okay, and I'll subtract the return on the equity. The equity return is given by ST divided by ST minus 1. This is the equity level at point T. This is the equity level at point T minus 1. So if the price is increased, the equity level increased, that means I will have to pay something. Okay, but if the equity level go down, like ST is lower than ST minus 1, that means I am getting a benefit because I'll have to pay the equity return that someone is getting. But if the return is like in negative terms, then I will not have to pay anything. Okay, so it is multiplied by NA, the notional amount of the equity, minus the present value of difference between the par value of the fixed rate bond and the notional amount in equity. Generally, the par value is always equal to the notional amount of equity. So in that case, like this term comes out at 0 and you are only left with these two terms. See, derivatives is like it's all about calculations. Okay, the more problems that you like practice, the more you will be able to solve the questions. I've just given an overview of the formulas and all those concepts that are included in the chapter. But if you are facing any issues with solving the questions, with solving solving the examples, you can reach out to me at my WhatsApp number given below. Okay, I'll try my best to help you out. Thank you very much.